Good afternoon, everyone. This is Abid Khan, and you are watching Karachi Academy YouTube channel. So we are doing CIE A Level Accounting Paper 9706, 9706, Paper 3, Version 2, and we have selected May-June attempt. We have selected May-June attempt 2022. So we have done couple of questions, and today we will be doing question number 2. So let's move on to question number 2. We have to actually finish our video. We have to keep it video and have to complete question as well. So question number 2, ABC Private Limited Company is private limited company. Sorry. ABC PLC means public limited company is a trading company. Okay, they do trading business. Draft profit from operations for the year ended 31st of December. This is draft profit. Okay, was 98,000 before following items were considered. Fine. In calculating this 98,000 draft profit, they missed out the following information. They did not account for the below information. So we will account for that. It means the profit is not correct. We have to make it correct, right? On 1st September 2021, ABC Public Limited Company issued a 6% debenture for 200,000. So accounts are made on 31st of December 2021, and they have issued debenture on 20. Okay. Then note number, working note 1 we can make. It means in September, 1st September we have issued this. So September, October, November and December, 4 months of the interest. So they have did not consider these items, so they have missed out the interest. So how much interest? So interest expense 6% on 200,000. This is 12,000, right? Let me have my calculator. So 200.06, it is 12,000. So this is for 12 months, and September, October, November, December means 4 months. 4 months of interest he has missed out, mean he ignored or he did not consider. So we will consider this interest. So how much would be 12 by 12, 1,000, and then multiply by 4, this will be 4,000. So 4,000 of the interest we will deduct. He did not deduct it, so we will deduct it. Okay. So what is requirement here? Prepare a statement to show the profit for the year. Prepare a statement to show the profit for the year. So we have to work out a corrected profit, right? So this we will deduct. Okay. Now go on to other point number 2, revaluation reserves at 1st January 2021, 72,000. On this is opening reserves, right? In reserves account, revaluation reserve. So you have on first 21 balance you have is 72,000, right? Arose from the revaluation of the property on 1st January 2027. Actually in 2027 they revalued the property, and this revaluation was created at that time. Means you debited your property with certain amount and you credited revaluation reserve. Okay, so this was some sort of a gain on revaluation. So your property was revalued upside. So revaluation reserves the balance was transferred into the revaluation reserve. So this is a 72,000 is a result of revaluation which took place in 2017, right? Move on. The property was purchased on 1st January 2023. Okay, so this property was purchased in 2013 on 1st January 2013. It is depreciated using the straight line over its useful life of 40 years. No residual value. Remember, this was purchased in 2013 originally, and it was revalued on 1st January 2017. So 2013, 2014, 15, and 16 means 4 years that it was depreciated on the original value, and in 5th year, opening of the 5th year, it was revalued, right? So this is one thing. It means we have lost and revalued at what price it was revalued, the depreciated using the balance, right? It means now we have on out of the 40 years, on 1st of January 2017, they have now 36 years, because 4 years have passed. On 1st January 2017, the market value of the property was 432. Clear? So this was the revalued amount. It means it was the revalued amount. It was 432. Then from 2017 till, again this was depreciated, revalued on 2021. So from 2017 till 2022, they charged depreciation, annual depreciation at 432,000 divided by 36 years, because it was 40 years total life. 4 years have passed on January 2017, so it has 36 years. A straight line method is the depreciation. It means we can see how much is 432,000 divided by 36. So the depreciation, annual depreciation they have charged, this is per annum depreciation. So they were charging 12,000, right? So okay, so but what happened, this on 2021 January, the property was revalued against. Remember one thing, so here on 2017 when they revalued it, it was revalued upside, so there was a gain, means so that was there, that's why that gain was transferred to the revaluation reserves. Revaluation reserves was credited. It means this was some sort of a gain to you, to the business. Now what is happening here, now they are the 12,000 is your total. 12,000 is total, and if I see 4 years, how much total depreciation they have charged, 48,000. It means 48,000 depreciation has been charged, right? And then when we can see its cost was 432 revalued cost, and the depreciation was 48,000. The depreciation, accumulated depreciation was 48,000. Then it means 432 minus 48, so it is 384. This is book value, net book value. This is net book value on December 30th, 2020. 384 was total book value, right? So we will look into this. Question is a bit complex one. Okay, then the property was revalued at 296. Now what they are doing, this the book value revalue 2021 revaluation, they are revaluing it at 296,000, right? While the net book value was 384. It means this is a loss on, apparently this is loss on revaluation, because the book value is 384,000 and they are revaluing downward. So this time they are making loss on revaluation. How much? 384 minus 296, this is 88,000 of the loss, right? This is 88,000. This is working, we can say this is our working number one. You have to show this as a working note, right? This was the loss on revaluation, but already you have what is the accounting principle or the stated rules, that if you are making a loss on revaluation, and if in the prior years if you have made some gain on the revaluation, so the gain will be adjusted, the loss will be adjusted and net off with the gain. So gain on revaluation was 72,000. Actually this is loss and it was your gain. So net gain is 88,000 minus 72. So this is 16,000, right? 16,000. It means your loss is not 88,000. It is adjusted with the 72,000 of the profit. Net loss is 16,000. So this is net loss on revaluation. It is not 88,000, right? Actually it is 88,000, but it is adjusted. Last time we got gain on revaluation, so we will adjust that, right? So this we will be doing. Fine. Okay, the property was revalued again 296, so we have accounted for this. The bookkeeper had continued to provide depreciation. Okay, this is one point. The bookkeeper, so this we will look into this, because this 16,000 is a loss on revaluation, net loss on revaluation. Okay, the bookkeeper has continued to provide depreciation for the property based on the value of 432. What has happened here? When he calculated this 98,000, at that time on property he calculated depreciation this way, right? So we can make another working, and that could be working number 2. And in year 2021, despite they have downward revalue the property, so he was to calculate depreciation on 296,000. But in 2021, when he prepared this income statement, so he considered depreciation at 432, means they have overcharged depreciation. So let's work on it. The depreciation on 432,000 which they have charged, and which was on, it was 12,000, right? And the depreciation on 296,000 should have been how much? Now how many years we have? Because from 2017 on 1st January of the 2017 we had 36 years in hand. Now when the revaluation is happening further 4 years we have lost. 2017, 18, 19 and 20, and in 21 January we are revaluing the assets. It means further from this 36,000 further 4 years have passed, means 32 years we have in hand. So now this revalued amount will be depreciated on, so 296,000 divided by 32, so the depreciation should have been 250, right? And how much he has charged? This is extra depreciation charged, 12,000 minus 12,000, 12,000 minus 9,250, 2,750. This is extra depreciation. So he has overcharged the depreciation on these non-current assets, on this property. Number one, he has overcharged, so he has reduced the profit by overcharging. So we will be adding this, right? So working note number two. Now move on and see what other says. What are the other requirements? In financial statements 2020, a non-current asset was wrongly classified. Okay, in non-current asset, something was a current asset, it was wrongly classified as a non-current asset, and in the total non-current asset that was included, and with the effect that the depreciation had been overcharged by. So that when we added wrongly, we added some asset into the non-current assets, so depreciation calculated on non-current asset, it was over depreciation overcharged by 20,000, right? 20,000 in 2020 and 14,000 in 2021. As far as this 14,000 is concerned, so this is the current year mistake. So this has affected the draft profit of 298,000, whatever 98,000, right? So this 14,000 you have overcharged. So ultimately this will be deducted from, so working note number, we can say 3, this 14,000 depreciation overcharged. So again this will be this has been deducted, so this we will have to add this back to the profit. Okay, move on. AB Public Limited Company sells goods at a markup of 40%, 60%. 60% is the markup. In December 2021, defective goods with a sales value of 28,000. Its sales value was 28,000. Were returned by the customer. So this is sales price, and how much they are charging? Actually, their cost plus markup equals to sales price. The cost is 100, markup is 60, 100%, 60%, then selling price is 160%. It means 1.6. If I calculate this one, so we in working number 4 we can see how much was the, or we can work out here. So what were the cost price? The cost price was 28,000 sales price divided by its percentage, 1.6. So cost will come to 28,000 divided by its percentage. You will go back to the original one. So cost was 17,500. So original cost of this returned inventory was 17,500. Okay, the cost value of the goods had been included in the inventory. So he has very rightly included this inventory because this is your inventory and you will be valuing this at cost. So this 17,500, Okay, but what happened in inventory 31st? It is expected that if 6,000 is incurred to repair the return goods, they can be sold. Okay, the return goods were having some problem, damage or something of issue. So if you want to sell it, then you have to incur some additional cost of 6,000. So it means if we see the net, we can say working number 4, how much it means is selling price. It is expected that 6,000 incurred to repair the return goods, they can be sold at 80% of the normal price. Okay, the sales price, how much would be? This will be the 80% of original price. Original price, sales price were 28,000. Its 80% will be 28,000. 80% will be 22,400. 22,400. 22,400. This is the sale price. Now these are the damaged goods. So if you want to sell them, number one, you have to invest some 6,000 on it, and then it will be sold in 22,400. So the selling cost, the cost to incurred, additional cost to incurred is 6,000. It means how much will be the cost that we will be, the prices we will be getting? 22,400 minus 6,000 is incurred cost. Net we will get 16,400. So we will be getting 16. So this will be NRV, net realizable value. So NRV of this stock will be 16,400, and we know International Accounting Standard 2. What International Accounting Standard 2? It says IAS 2. What it says, lower of cost or NRV, you have to consider as a value of the goods. So your cost is 17,000, and 17,000, your cost was 17,500. Okay, so in inventory you have to consider lower one. So 16,400 you have to consider one, right? This should be your inventory. Actually, in your inventory you have included 17,500, and while making a profit and loss account, the closing inventory you took was 17,500, while it was to be 16,400. And do remember one thing, whatever if you any increase or overstatement if you overstate the closing inventory, you will overstate the profit. If you understate the closing inventory, you will understate the profit. So he was to take 16,400 in inventory while working out the profit and loss account, but he has considered 17,500. So he has overstated. So he has overstated the profit. So the difference, the overstatement of the profit is, this is working note number 5. The overstatement of inventory is how much? The difference, say 1750. So this is 1100. So by 1100 you have increased the inventory, it means you have increased the profit, so that will be deducted. So almost we have done all the things. So we have to prepare our draft profit and loss we can make here. Almost we have done with all the things, so we can make our corrected. Okay, then move on. So the corrected profit, whatever the company name is, AB Public Limited Company, the corrected profit for the year. The, the report draft profit was draft profit was 98,000, right? This was the draft profit. Now we did not consider this working number one, interest, 4,000 of interest on debentures. We did not deducted this. So interest on debenture is 4,000. So we did not deducted this, so we have increased the profit, so it means this will be deducted. You have to reduce your profit because you did not consider this expense. Now you have to consider number one, and this is under working number one. What is the next is working number two. Here the extra depreciation. So here we the property was to be depreciated at revised value, revalued amount of 296,000 by 9,250, but he wrongly calculated while drafting the profit, while making the draft profit, the depreciation on the old amount of 432. So he has extra, he depreciated by extra, so this means overcharge the depreciation expense, so reduce the profit. Now you have to increase it, 2750. Working note number 2. Depreciation overcharged on property, right? Then move on. Okay, another point was here, it was right, this was 14,000. This point in financial statements of 2020, a non-current asset was wrongly classified with the effect that depreciation was overcharged 2020. So as I told you that this 20,000 in 2020, this is not this year, this is prior year error, so this will be adjusted against the retained earning. But while here, why we are not considering this year, we are correcting this year profit. So this year profit, so we will consider this only 14,000. So 14,000, so this 20,000 will be adjusted against the retained earning of the, which is accumulated undistributed profit of the last years. So for this year, correction of profit for this year, we will consider only this 14,000, and this 14,000 was extra charge, means your profit was, you overcharge the depreciation and you understate the profit. Now you have to overstate your profit, means now you have to correct it by 14,000. You have to add 14,000 wrong overcharge of depreciation. It was wrong overcharge, so we have done this one. So now what else is remaining here? Okay, the last one, which is okay, the property and equipment and all this we have done. So last one was this inventory part. So here in inventory, what we have what we discussed. So he took 28,000 of inventory at a cost of 17,500, while its NRV was 16,400. So he was to consider NRV 16,400. So excess how much? 1,100. So 1,100 he overstated the inventory by 1,100. It means he has overstated the profit, right? Because as I told you, closing stock it has a direct relationship with the profit. Overstating the closing stock, overstating the profit, understating the closing stock, understating the profit. So we have overstated. So what we will do, we will deduct this or we can say inventory adjust check. So this we will deduct. So this will be our corrected profit. How much? 90. It will be 98,000 was the profit, minus 4,000, and then plus 2750, and then plus 14,000, and then minus 1100. This will be 109,650. So this is your corrected profits. So guys, we have done with question number 2 and part A. So the remaining part B and C, the C is also there, B and C. C is a longer one, so we have to make our video short. So we will, in the next video, I'll be covering this C, B and C both, right? That's all for today. If you have any comment or any clarification or any doubts, you can write on the comment side of this video, and we will try to respond to you very quickly, and so that you and that will be helpful to you in your next week examinations. Thank you very much, and bye for now.